Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
Today we're sharing 3 stories. First, we'll look at why secretive chip machine monopolist ASML just dropped $1.5 billion into Mistral AI, creating a European tech powerhouse to take on Silicon Valley. Second, the resignation of Japan's Prime Minister Shigeru Ishiba has markets on edge. We'll break down why a return to Abenomics could threaten Japan's $1 trillion holdings of US Treasuries. And third, an appeals court ruling against President Trump's tariffs has the US Treasury on the hook for up to $1 trillion in refunds. A logistical nightmare Secretary Scott Bessent says would be terrible. The most unexpected news in the finance world today has to be this. A single company just dropped $1.5 billion to become the top shareholder in an AI startup. This isn't a tech giant like Google or a venture capital firm. It's ASML, the secretive Dutch company that holds a global monopoly on the machines that build the world's most advanced computer chips. So the thing is, ASML is the only company in the world that makes the extreme ultraviolet or EUV lithography machines required for cutting-edge chips. We're talking about machines the size of a bus that use lasers to etch circuits smaller than a virus onto silicon wafers. This gives them an unprecedented choke point on the entire global tech industry. Their target, a French startup called Mistral AI, often hailed as Europe's answer to OpenAI. With this single investment, ASML is funding the vast majority of Mistral's new $2 billion round, rocketing its valuation to a jaw-dropping $11.7 billion. That officially makes Mistral the most valuable AI company in Europe, nearly doubling its value from just last year. But this isn't just about money. This is a strategic power play with massive geopolitical stakes. Sources say the move is designed to strengthen European tech sovereignty and make the continent less reliant on AI models from the United States and China. This move is so significant because experts are calling it the creation of a European AI stack. Think of it like a tower. At the bottom, you have ASML's hardware, the physical machines that make the chips. Now, at the top, you have Mistral's software, the AI models that run on those chips. By controlling both the foundation and the penthouse, Europe is trying to build a self-reliant technological fortress, an initiative some are calling Eurostack, to compete directly with American and Chinese tech ecosystems. On a technical level, research shows that large language models like the ones Mistral builds can be used for something called computational lithography. The AI can analyze incredibly complex patterns and predict how to adjust the lasers in real time to prevent defects, potentially boosting manufacturing yield by 5 to 10%. That's a massive improvement in an industry where every single percentage point is worth a fortune. It's a shift from just selling tools to selling integrated AI-powered manufacturing solutions. But the bigger story is the formation of a European tech alliance aimed directly at challenging Silicon Valley. This decision brings both incredible strategic advantages and comes with inherent risks. For instance, what happens when a hardware monopolist also becomes the top shareholder in a leading AI company? Regulators will be watching closely for any signs of anti-competitive behavior. There's also a potential culture clash brewing. Mistral built its reputation on an open source approach, while ASML is famously secretive. How these two cultures merge or collide could determine the future of this new European champion. Now, that story was about a major power play in European tech. Let's shift our focus across the globe to Asia, where a political shakeup is sending its own shockwaves through the markets. The Prime Minister of the world's third largest economy, Japan, has just resigned. When we say markets are bracing, what that actually means is that modern algorithmic trading systems, especially high-frequency traders, are built to react in microseconds. They scan news headlines and sentiment data, and a political shock like this triggers an immediate reevaluation of risk. In a market as massive as Japanese government bonds, these algorithms can either provide stability or, if the shock is big enough, amplify volatility by all moving in the same direction at once. The departure of Japan's Shigeru Ishiba, a known fiscal hawk, has thrown open the door to a dramatic policy reversal. The markets are now betting on a return to Abenomics, a policy defined by massive government spending and unprecedented monetary easing. To understand the stakes, you have to look back at the first round of Abenomics. While it aimed to jolt the economy out of deflation, the era of ultra-low interest rates had a significant side effect. It created what economists call zombie companies firms that were not profitable enough to survive on their own but were kept alive by cheap debt. By 2023, there were an estimated 250,000 such companies in Japan. So a return to this policy isn't just a simple stimulus. It risks propping up unproductive parts of the economy. The reason this reverberates globally is that Japan is the largest foreign holder of US government debt, with over $1 trillion in US treasuries. If instability in their own bond market forces Japanese investors to sell those foreign assets to bring cash home, it could cause a spike in US interest rates. That means higher borrowing costs for everyone, creating a ripple effect across the entire global financial system. The pressure is already showing. Yields on 30-year Japanese government bonds just hit an unprecedented high, while the 20-year yield surged to a level not seen since 1999. This means borrowing costs are soaring for the government, for corporations, and for the public. Now, this is where the situation takes a more complex turn from a technical standpoint. The Bank of Japan isn't just guessing. They use incredibly sophisticated computer simulations, primarily what are known as dynamic stochastic general equilibrium, or DSGE models. They are trying to game out exactly what happens when the central bank, hit the brakes while the government might be about to slam the accelerator. The problem is, these models are great at economics, but they struggle to quantify the sheer unpredictability of political chaos. The core conflict is clear: a central bank trying to apply the brakes versus a political class that may be about to slam its foot on the accelerator. One of the top contenders to replace the Prime Minister, Sanae Takaichi, has openly advocated for boosting government spending and keeping interest rates low. You know, that recent Nikkei rally didn't happen in a vacuum. It was driven by major corporate governance reforms, pushing Japan's giant companies to become more efficient and shareholder-focused. A new era of easy government money could remove the pressure for those difficult but necessary changes, potentially stalling a historic economic shift just as it was getting started. Speaking of financial instability and its impact on US government debt, the Treasury Department is facing a completely different but equally massive challenge on its home turf. Let's start with a single statistic that might just change your entire perspective on trade policy. The US government could be forced to issue up to $1 trillion in refunds. And no, that's not a hypothetical. It's the bombshell scenario facing the Treasury Department right now. A while back, we walked through the appeals court ruling that set all of this in motion. Today, there's a major new twist. An appeals court just delivered a stunning blow, ruling that most of President Donald Trump's tariffs are illegal. The administration is now scrambling, asking the Supreme Court for an expedited ruling to save its signature trade policy. As we noted before, that was a 7-4 decision, paused until mid-October to give the administration a window to seek Supreme Court review, exactly the window they're trying to use now. And remember, this isn't narrow. It sweeps in tariffs on most countries, including major partners like China, Mexico, and Canada. The core of this legal battle, as we've touched on before, centers on tariffs imposed under something called the International Emergency Economic Powers Act, or IEEE. The lower courts have essentially said that this act does not give a president the authority to impose these kinds of sweeping tariffs, arguing that power belongs to Congress. And just this week, Treasury Secretary Scott Bessent put a staggering figure on the line, warning that if the courts ultimately strike the tariffs down, his agency would be on the hook for what he calls massive refunds. He said delaying a final decision could mean between $750 billion and $1 trillion in tariffs will have already been collected. Unwinding that, he says, would be terrible for the Treasury. The administrative challenge here, beyond just the dollar amount, is almost unimaginable. We're talking about what could be one of the largest administrative efforts in US government history. The US Customs and Border Protection, or CBP, would have to manage this. They have records, but the process would be a logistical nightmare involving either automatic payments or requiring thousands of individual companies to file claims. The sheer administrative burden of processing that many refunds would be absolutely immense. And this isn't just a headache for the government, it impacts key sectors of the economy. According to the Progressive Policy Institute, the hardest hit sectors were manufacturing and construction. We're talking about industries like electrical equipment, which paid an extra $7 billion in tariffs in just 1 year, along with fabricated metals, steel, and auto parts. If that money comes back, it could be used for anything from new investments and lower prices to stock buybacks for shareholders. And continuing our last discussion about tech, companies like Apple, Google, and HP spent years and billions de-risking by shifting production from China to places like Vietnam and India to avoid these tariffs. If the tariffs vanish or return under a different authority, that calculus gets even messier. But that's not the whole picture. Even as they express confidence, officials are quietly working on backup plans. National Economic Council Director Kevin Hassett confirmed the administration is exploring other legal authorities to reimpose tariffs if the Supreme Court rules against them, potentially using national security justifications. When they talk about national security, they're pointing to a different law, Section 232 of the Trade Expansion Act, which allows the president to impose tariffs if imports threaten national security. As we noted earlier, those Section 232 tariffs weren't touched by the appeals court's ITRIPA ruling, which is why this route is back on the table, reviving the same presidential authority shopping debate we talked about before. The controversy is that this definition of national security has been expanded to include things like economic competition in the tech sector, a justification that has been challenged in court before. Ultimately, what's at stake here is a core constitutional principle that Congress, not the president, holds the fundamental power to set major economic policies like taxes and tariffs. The courts are now being asked to draw that line, and a potential $1 trillion price tag is hanging in the balance.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.